Hello, welcome to week 2 of personal finance. So I just wanted to check in and give you guys a little bit of a welcome to the week and then walk you through some of the homework for this week. So we're going to have a tax conversation because chapter 2 or chapter 3, I mean, is all about taxes and students in general struggle with that topic. It's such an important topic, literally one of the most important topics that we cover. And one that a lot of Americans don't understand, but honestly, it's nothing that complicated. We will not be doing anything that's crazy complicated. I would tell you guys that I actually teach an entire class dedicated to tax for my accounting majors, and I do not go very far for personal finance because we can't cover as much depth as what we do in a class for accountants. And so we just kind of touch on tax topics, but nothing crazy. So as far as week 2 goes, you're going to do chapters 3 and 4. So for chapter 3, there will be a discussion board, an assignment, and a quiz. For chapter 4, there will be a discussion board, an assignment, and a quiz. Chapter 4 is very straightforward. So chapter 4 is about banking specifically and identity theft. So your discussion board will ask you to just identify some things you use to avoid identity theft. If you don't know, just Google an article and read about it and then give your answer. Last semester, I don't know what happened, but I had people who like in the discussion board would say, I don't really know anything about identity theft. And that was their answer. And I was like, oh yeah, no, that's not what's supposed to happen. So go ahead and if you don't know about it, that's kind of the purpose of the class, go research it and identify that. Also there's a banking activity. And then the quiz. The quiz, again, 30-minute time limits, everything's due Sunday night at midnight. Let's look at the chapter 4 assignment real quick, just so you can see it before I move into chapter 3, which is the big one. So this banking activity, again, this is an assignment that I remember last semester having some issues with. It's very straightforward. So literally all you have to do is, if you have a bank, use your bank. If you don't have a bank, find a bank online. Or go into a physical bank if you want, it doesn't matter, and ask them these questions. You can find all these questions online for a bank. So when it opens up, you're only doing the tab that says homework. I just noticed there was one that says in-class activity. You do not have to do in-class activity, just homework. So I will go over and make sure I'm clear about that. Maybe I'll just delete the in-class activity tab and just have you do the homework tab, obviously. Okay, so all you have to do is name the bank. And so before you can type here, hit enable editing. Go. Okay, so the name of my bank is Citizens National Bank. I still bank in Concordia, Kansas with my mom, which is a little bit weird. But that's where I've always banked my whole life. So I just kept doing it. So same thing over here. And so by the way, if I want to put that exact same cell over here, I can just go to the corner like that. And so right now it's a fat plus, arrow plus, skinny plus, click, drag over. And it just copies that over or fills it in, okay? So interest rate earned on a checking account versus a savings account. Is there a minimum balance? Is there a minimum to earn interest? Is there a fee for online banking? And so on. So you're just going to answer these questions. And then I have 3 questions down here. And that's it. So really straightforward. On this assignment, that was the reason why I was giggling. And like the student wrote IDK, IDK, IDK on all of them. And I was like, what? And then down here, the student wrote something like, I don't know, my mom takes care of my banking. And I was like, well, then ask her. Like, it's okay to find out. So anyway, don't answer IDK. That's not the answer. Okay. So anyway, answer these 2 columns, no big deal. I used to have a 3rd column here that was like some other kind of account. Like you could just identify any kind of account, like a CD or a money market account or other kinds of bank accounts. But students just got really confused by it. And I decided to just go with the 2 basic ones and then ask a few questions down here. So, all right. So that's the banking chapter. So I will hit don't save and come back over here. Okay. So back to week 2. So chapter 4 stuff we just went through all 4. Hey, Andrew, Can you let Rosie in? I think she's in the backyard. You just saw her in the front yard? Well, buddy, let her in. She's not supposed to be outside by herself, honey. No, we're all inside. She's in the backyard. I don't know how she got into the backyard, but can you go to the backyard, please? She just ran by back there. I don't know what's going on. Sorry about that. Okay, sorry about that. I don't know why my dog's in the backyard. I just saw her run by the window. Okay, so now on to chapter 3. So on chapter 3, the discussion board is to watch this video and then ask a question about taxes, something that you didn't quite understand or something that you want to know more about. So maybe it's a child tax credit or something like that, just something in general that you are confused about. Hi, Rosie. Sorry, are you hot? I know it's so hot out there. I don't know what happened. How did you get outside? Okay. All right. Say hi. Cool. Say hello, man. Okay. All right. Go play. Go play. All right. Ugh. Okay. So, okay. So the tax chapter is one where we need a broad understanding of how taxes work. And then there are literally 1,000 tax rules and exceptions to rules and all kinds of things that you might want to know more about. So maybe you work for a farmer in the summer and you want to know how you're going to pay taxes because he just writes you a check, but he doesn't withhold any money. That would be a good question you can ask. You can ask me any tax question. If you don't have any tax questions, ask your parents if they have any tax questions, or ask a friend and say, so what do you not understand about taxes? What would you like to know more about? And then I want you to go and try to answer someone else's question. And I'm going to jump in and answer questions too, because I love taxes. It's my favorite. So, so if I want you to try to answer someone's question, like something that you actually do understand about taxes. And so you research a question and try to answer it. And then I will help guide the conversation as well. So just something fun, tax related. When we did this in class, I had them all I taught a class, this personal finance class as a hybrid during the semester. And I had people in person on Tuesdays, but then Thursdays they were online. So I had them ask a question for the discussion board. And then the next week we talked about it in class and I answered all their questions. And so I just wrote all their questions on a piece of paper and I was like, somebody wants to know about self-employed people or whatever. So it was good. Okay. So because I wanted to talk about several issues related to tax, I have some notes that I'm going to kind of sort of fill in just to kind of keep us focused as we go through. And so these are the notes that I use in class. I'm not going to go through all of it, but these notes are very handy because they're probably going to answer quite a few questions from the quiz. So, so as far as taxes go, you encounter taxes every single day, all day. So today I dropped Claire off at camp. She got on a bus and she rode off into away, and I was like, oh, that's my baby. So she was riding on a bus, and the bus to run needs gas, probably diesel, but I don't really know. But there are taxes on gasoline. Okay, so that's called an excise tax. The vehicle itself is property. So when I drive my car around, I have to put a sticker on the back of the car every year because I pay property taxes on the car. A house, you pay taxes semi-annually. So that means every 6 months you pay your taxes on your house. Those are due, I think, in May and November. I just have it as part of my house payment and they just divide it over every month. So I don't have to come up with a big sum of money twice a year. There are income taxes, and that's what this chapter is about. There's sales tax. And so for sales tax, that's when in Wichita, it's 7.5%. So if I were to go to the store and buy $1,000 or not 1,000, good grief, $100 worth of groceries, then my bill would be $107.50. Now, I do know that the sales tax on groceries is going to start dropping by 2 cents each year until we will no longer have sales tax on groceries. So that's very exciting. And so that's going to happen sometime over I think it's between now and 2025. They're going to phase out sales tax on groceries. But if I were to buy a car for $10,000, then I would have to pay 7.5% of 10,000, which I don't even know what that is because I get my decimal places always screwed up. 10,000 times 0.075, $750 in sales tax. That money goes to the city, state government, and then it's used to pay for stuff. So there are people all over the world or all over the country who are very cranky about taxes in general. Why do we have to pay taxes? And I have probably a different opinion about taxes than a lot of people. Obviously, I don't want to pay them either. Nobody does. But I'm very thankful that if my house were to catch on fire, that I could pick up the phone and I could call 911 and a fire department would show up. The way that happens is they use money from the tax base to be able to make that happen. So at the federal level, when I pay federal income taxes, I am thankful that we have government protection and we have interstate highways and all the things that money goes to pay for. All the money has to come from somewhere. So if you live somewhere like Nevada, you don't have sales tax. The reason why you don't, no, you don't, I'm sorry, you do have sales tax. You don't have income tax. The reason why you don't have income tax is because they have so many tourists that come through, they get their money other ways. So they don't have to have an income tax. Every state collects money in different ways to be able to run their state. The federal government collects their money in different ways to be able to run the federal government. And those taxes are there for a reason. So unemployment taxes are another example. Those are paid by employers, not by you as a person. So that's just taxes in general, like different kinds of taxes. So I want to explain the basic concept of taxes before I go any further. And so, oh, it's a big picture of my face. So if I were to talk about taxes and how taxes work, the basic idea is, okay, you get a job. Yeah. You get a job, and when you get a job, you get a paycheck. And when you get a paycheck, if I were to hire you to work for me for $10 an hour and you work 10 hours, that's $100. But when you get your paycheck, it will not be $100 because of taxes. So money is withheld for taxes, Social Security, Medicare, federal income taxes, and state income taxes. So all through the year, money is withheld from your paycheck. So this is the basic 1-minute explanation of taxes. Ready? It's 12:19 on my clock. Oh, 12:20 on my clock. Let me add 1 minute. So what happens is all through the year, they withhold money, withhold money, withhold money. At the end of the year, you get a W-2 from your employer. That shows the total that you earned and what was withheld. Then you do a tax return. The tax return calculates what should have been withheld. Then you compare it to the W-2 and you either get a refund or you pay money in. That's it. That's the basics of taxes. So less than a minute, 1 minute explanation of taxes. So you work all year, they withhold money. At the end of the year, they send you a W-2. Then you calculate what should have been withheld. You compare it to what was actually withheld, and you either get money back or you pay money in. That's it. Okay. So that is the basic explanation. That did not consider tax credits and all of the extra things. So let's go back and share again. So the basics of it. This question says, does wise financial planning include getting a large income tax refund each year? And the answer is no. You should try to have money withheld based on what should be withheld, because it's your money. They withhold it all through the year. And then if you get a refund of your money, the government basically used your money all year long. Now, there are exceptions to that concept. So as an example, you guys potentially, if you are in school full time, do not need to have much withheld. So when you get your refund, it was your money all along, but they're probably going to withhold some regardless. You can ask them to withhold less. That's done with a W-4. A W-4 is the form you fill out when you start a job, and it says how many people your income supports and things like that. So it says if you're single or if you're married. So if I were to do one, then I would say that I am a married person and we have 3 children that we are supporting. So maybe Tor claims one of them and I claim the other 2, or however we want to do it, so that money is withheld based on that, because every one person can be claimed by on one tax return. Okay, so that's leading to all kinds of questions in your brain, I know. So here are just different explanations of different kinds of taxes, everything from inheritance taxes, estate taxes, all kinds of taxes. So what we need to do is we need to figure out how to calculate taxable income, because that's going to be a big part of your overall homework. So I'm going to hit delete right here because I don't know what's under there. Uh-oh. Hold that. And again, like this active versus passive income and things like that, that might be addressed in some of your quiz questions. And so I thought it was good stuff to just leave in there. But where, here, this is where I want to type. I'm going to just type it right here. I thought it said 15 pages earlier. I don't know what happened. Okay, I'll just type right here to be able to calculate taxable income. So the first thing we're going to do is we're going to include all of your income. Income is when you do something to earn income. So types of income are active and passive. Active is when you work for the money. So we're going to call those numbers gross income. I don't know why it's underlining. There we go. So we're going to start with gross income. Now, gross income is stuff that you earn. And so it can be earned or passive or whatever, but it's money coming in. So as an example, if you receive interest from your bank for your savings account, that is income. What I always tell my students, and because they're always like, taxes are so confusing. And I'm like, well, if it feels like income, it's income. All right. So if you get a gift from, like, if you win a prize, like if I were to win the lottery right now, like that's income. I'm getting money given to me. If I were to like win a raffle at a church, that's money I'm earning, I'm receiving. It feels like income, it is income. So some things are excluded. And if they're excluded, that means that the government has decided that when you receive that, it's not income. But this is stuff you basically work for. And then from there, we will subtract deductions for AGI. So deductions for AGI. So do I call them anything easier than that? I'm just looking. Adjustments. Yeah, I'll just call them adjustments. And so I call those deductions for AGI. And these are things that the IRS has decided that you get to subtract. This would be things like student loan interest. So the government likes to reward you for doing certain things. So if you are going to school or you went to school and you have to pay student loan interest, that student loan interest is deductible. Now there's all kinds of rules. If you're a single person, if your gross income is more than 65,000, they start limiting that. Or if you're a married couple, if it's more than 130,000, they start limiting that. So there's all kinds of extra rules, and I think you can only deduct up to 2,500 or something like that of interest, but that's a lot of interest. So there's rules with it, but in general, we understand that student loan interest is something the IRS, the Internal Revenue Service, allows you to write off. Another example would be contributions to traditional IRAs. Okay. So there are all kinds of other ones, but in general, there are a bunch of deductions for AGI. We get to subtract those, okay? And that gives us adjusted gross income, also known as AGI, which is a very important number when you're calculating your taxes. So it's one that we will discuss often and need to understand. So once we get our AGI, so all it is gross income minus deductions. So if you work at Taco Bell and that's all that happens, or like my Lauren is going to lifeguard at Orchard at a local swimming pool. If that's all she does all year and that's all she has, then she would put her lifeguard wages here and she has no deductions. So then her AGI would just be her lifeguard wages. Okay, just so we can be basic here. From there, we do subtract standard or itemized deductions. Okay, so you get to subtract the standard or itemized deductions. So you pick the bigger one because you want to subtract as much as possible, because we in general would like our taxable income to be little, so we pay little taxes. Okay, so the standard deduction is set by the IRS, and it's different for a single person versus a married person, and you subtract that number. Or if you can itemize, you subtract your itemized deductions. So standard is given, itemized are things like charitable contributions. Okay, that's not the best example because it's also things like real estate taxes, and it's also things like certain medical expenses if they exceed a certain amount, a percentage of your AGI. And so home mortgage interest. Okay, so there's a whole bunch of different itemized deductions. Itemized ones, you only subtract them if you're itemizing. So you will look at your standard, and if your standard is 25,300, because you're a married couple and that's not the right number, I just made it up. So if your standard is 25,300, you would add up all of your itemized deductions. Add them. And if that number is 18,000, would you rather subtract 25 or 18? We want to subtract as much as possible, so we would just take the standard deduction. So that's how that works. So here, itemized are things like charity, taxes, medical. Okay, and that gives you taxable income. Okay, from there you will, so once we compute taxable income, then calculate tax based on that number. All right, so that's called taxable income, and that's the big number that we will be shooting for. Thank you, Andrew. And that's kind of the number that we're always trying to find, is taxable income. And so now on the next several pages, I'm just going to go through and identify things that are income or things that are not income. So as an example, gifts are not considered income. So I love you guys. And if I decided that I wanted to give each one of you $5,000 just because I love you, I'm allowed. I can give $5,000 and there's no tax consequence to you. You receive it. It's a gift. Now that's different than a prize. And I know that that seems weird, but a gift is from an individual. It can't be from your employer because you work for them. So that's considered compensation. So a gift from me to you would be considered a tax-free event. Same thing with an inheritance. If my grandma were to pass away and she gave me $100,000, I'm crazy. If she gave me $100,000, there would be no tax consequence to me. None, zero. Now, there are some special rules related to gifts. The person who is giving the gift, like my grandma, she may have to pay tax on the gift, because if your estate is of a certain value, then you have to pay estate taxes. And so if you're trying to give away your money to get out of paying estate taxes, the government has decided that you have to pay tax on gifts. And I think the gifts can be up to maybe 15,000. I don't know. I'd have to look up what the actual rule is on gifts. And I'm sure it's probably in here somewhere. Gifts amounting greater than 15,000, it's 16,000 this year, are subject to tax. The giver is taxed, not the receiver. So if my grandma gave me $20,000 as a gift before death, then she, not me, my grandma, the giver, would have to pay tax on $4,000 because she gave me more. If she gave me a $20,000 gift, she gave me more than the limit. So if she's smart, she would give $16,000 to each one of her grandkids each year until she dies to shift income to us if she were wealthy. She's not. So she lives on Social Security and gets like $1,000 a month to live on. And so she does not have that kind of money to give. That's why I was like, oh, that would be awesome. Okay. So we'll talk about my grandma when we talk about Social Security taxes in general, because when I pay those money, when that money comes out of my paycheck, I just think of it like going to take care of my dear grandma, who I absolutely adore, who needs all that money to live on. So anyway, okay. So back to other things that are not considered income. Scholarships. Your scholarship that you receive to go to college is not considered income unless you get scholarships more than the cost of education. And the cost of education can include books and all kinds of other things. And so it doesn't normally exceed that. So there's information here about capital gains. That's a little bit more than where we need to go, but that's when you buy a stock and then you sell it and you have a gain on the sale. So these are the adjustments. These are the deductions for AGI. I mentioned student loan interest and IRAs. I didn't mention alimony. So alimony is different than child support. So did you hear me? Alimony is different than child support. Child support is for your children, to care for your children. Alimony is spousal support, spousal maintenance. And so it's when you get a divorce and there was one party of the marriage that earned more money than the other party. And in the divorce agreement, there is an agreement that the party who made all the money would take care of the spouse for a certain number of years. So that money that you pay as alimony is a deduction for AGI. Alimony received is income. So if you take a deduction for alimony, they ask you the social security number of the person that you're paying it to, so they can go look at their tax return and make sure they pick it up as income. So child support, though, is not anywhere on a tax return. Did you hear me? Nowhere. Okay. Because child support is to take care of the children, and that does not belong. It's not a deduction because it's your job to take care of your children, and it's not income because you're using it to take care of your children. So when you are getting a divorce and the lawyers are arguing about the different things, it's very important that the things are clearly identified because when you do your taxes, you need to know if it's child support or alimony. Okay, and that gets you AGI. And then after AGI, so all you do is income less deductions gives you AGI, and then you get either a standard or you itemize. So here's the list of some of the itemized deductions. When I said like charitable contributions, like a mortgage interest, like medical. So for medical, it has to exceed 7.5% of your AGI. So what that means is you go to your AGI, and if your AGI is 100,000, it's just an easy number for me to do math with. If your AGI is 100,000, then you only get to have an itemized deduction for medical if the amounts exceed 7.5% of 100,000, which is 7,500. So if you have 7,600 of medical, it's only the excess. So just $100. Okay. The reason why they do that is they don't want you having to keep track of all the little baby medical expenses. Like if you go to the Dillons and get a prescription and it's $3, they don't want you keeping track of all of that necessarily. It's only if you itemize. And remember, I mentioned that you might take the standard and not even itemize. It's only if you itemize. And then for medical purposes, it's only if it exceeds 7.5% of your AGI, which I've never done that personally. Thank the Lord, because that means I haven't had a lot of medical issues. My parents have. So my parents have had enough medical that they have it. My grandma will this year because she moved into a rest home last month, April. Yeah. And so when she now has all of the rest home expenses, those are considered medical. So she will be able to itemize next year. I do her taxes every year. So Moving expenses, I think, have been eliminated. I don't think you can write off moving expenses anymore at all. I think that the 2017 tax reform eliminated moving expenses as an option. There's a special rule for charity. So when they in 2017, and this is more information that you need too, but in 2017, they changed the tax rules and they doubled the standard deduction. So when they doubled the standard deduction, it used to be like 11,000 and then they bumped it up to 22. When that happened, a lot of people couldn't itemize anymore. So charity took a hit because if people couldn't write it off on their taxes, they stopped giving money to charity, which you don't give money to charity because it's a deduction, but it does incentivize it somewhat. It does convince you that it's a good idea to give money to charity. So, so charity started taking a hit. So now you can, like, they'll ask you, like, when you do your taxes, like you can do your taxes with the computer. It's very easy. They'll say, did you give any cash contributions? And so cash contributions up to $300 can go up here. And not alimony specifically, but in the adjustments to gross income. So you can actually pick up $300 of charity up here, even if you don't itemize. So I'll see that on the homework a little bit. I'll show you guys. Okay, so exemptions aren't a thing right now. What they did was they doubled the standard deduction and they eliminated exemptions. So when I gave you the tax formula, I did not include exemptions because exemptions are how many people your income supports, and they eliminated that altogether. So there is no exemption amount. So the next thing that we want to do is I want to show you how to calculate tax. So to do that, I'm going to do some of your homework for you. Are you ready? So watching this video is very helpful because I'm going to do some of your homework for you. So let's pick up our chapter 3 homework, 2 tabs, watch video for many of the solutions. And so let's go ahead and open that up. Open. Oh, here it is. Okay. So the first thing you're going to see here is try again, try again, try again. And what's going to happen is when you enter the answer here, it will tell you if you're correct or not. So I said we did these in class together. So just move your answers from the notes. So what would the tax be on a single person with taxable income of $42,000? So what we're going to do is I'm going to show you how to use the tax tables. So we're going to go to the end of this document. So I'm going to hit Control End to go to the end of the document. And what I have are the tax brackets. The tax brackets. So I have the 2020 tax brackets and the 2021 tax brackets. The 2022 ones aren't out yet. They should be out. They might be out in June. So I would expect them pretty soon. But when I created these notes, they weren't out yet. So we're going to look at 2021. And we are looking at a single person with taxable income of $42,000. So I'm going to go to the 2021 brackets, and there are 4 sets of boxes: single, head of household, married, filing joint, or qualified widower, married, filing separately. Let's talk about those 4 boxes. Single people, unmarried, not married. The date that this is determined is December 31. So it is, what are you on December 31 of 2021? That's, so if you get a divorce and it's finalized on December 30th, then you were not married during 2021. You are a single person as of the last day, and that's what they measure it on. Married filing jointly is when you're married. Qualified widower is if your spouse dies and you have dependent children. So you have children who live at home or that you claim on your taxes. So that is a qualified widower. You get to be a qualified widower for 2 years. Okay. So in the year of the death of the spouse, you are married. Okay. And then you're a qualified widower for 2 more years. And so, because in the year of death, you have to file a tax return. So, okay. So then head of household, this is when you have a dependent, but you are not married. So you cannot be married in this box. You have to be a single person. But it's when you have a dependent. Now that dependent doesn't have to be a child. If my mom moved in with me and I took care of her, then I could claim her on my taxes if she qualifies as a dependent, meaning that I provide more than half of her support and all this other stuff. Okay. So, and then married filing separately, this is when you're married, but you do not want to file a joint return for some reason. Now, in general, this box looks very similar to the single box. So you'll see that the numbers are similar, but not the same. Because look when it gets up here, 209 to 523.6. This is 209 to 314, and then 314 and up is taxed at the higher bracket. Now, you probably have heard people say things like, I'm in the 10% tax bracket, or I'm in the 22% tax bracket. That's what this is about. So the bracket that you are in is the row that you are in. So we are doing a single person with taxable income of 42,000. So a single person, if taxable income is over, but not over. So the first row is 0 to 9,950. That's not our row. Okay. If it was, the tax would be 10% of the amount over 0. So we would just take 10% of, if my taxable income was 7,000, I would take 10% of 7,000 and I would get 700 as my answer. The next row is for taxable income over 9,950, but not over 40,525. Again, that's not our row, so just skip it. The next row is where we are. We are between 40,525 and 86,375. If taxable income is over 40,525, but not over 86,375, the tax is. So the answer, 4,664 plus 22% of the amount over 40,525. So what I'm doing is I'm reading this and talking about each row. So I'm going to read it as a sentence. If the taxable income is over 40,525, but not over 86,375, that's us. The tax is 4,664 plus 22% of the amount over 40,525. So our answer equals 4,664 plus 22% of the amount over 40,525. So when I hit enter, that says correct. Okay. So what I just did literally is I took the amount over 40,525, which would be 42,000 minus 40,525. The amount over is 1475. I took 22% of that and I added it to 995. So I got 13,1950. That's not right. I did the wrong row. Good grief. Okay. I mixed up my rows. I'm so sorry. Okay. So I'm going to go back. I'm going to do it again. So I need 42,000 minus 40,525. I need 22% of that. And then I added the previous row. It's this one, 4,664 plus 4,664, 4,988.5. Okay. So that's that one, 4,988.5. Let's go ahead and let's do I'll let you do this one. Oh, I'll do it. No, I won't. Okay. What would the tax be on a married couple with taxable income of 152? So a married couple down here with taxable income of 152. That's in this row again. I'm in this row because 152 is between 81 and 172. So I'm in this row. So the answer is 9,328 plus 22% of the amount over 81,050. So if I were to calculate it here, then I would say it was 152,000 minus 81,050. That's the excess. That will be taxed times 0.22. And then I'm going to add to that 9,328. 24,937. Oh, why does it say try again? What happened? Did I do it wrong? You're like, lady, if you can't do it, I can't do it. Does it say 152? What would be the tax on a married couple with taxable income of 152? All right, let's make sure I got it right. 152 minus 81,050 times 0.22 plus 93.28. Okay, so there's an error in my spreadsheet. Darn it, 24,937. I will fix it. Now, let me show you something. You ready? I'm going to check this. So you can't just type in the number and assume you're okay. But if I click right here, I can see the correct answer. This is an if-then statement. It says if this number is 46,530, say correct. If it's anything else, say try again. So it's looking for the number 46,530, which is not correct. So I'll go in and I'll fix it because that's not right. So let me do the other one for you, just so you know. 46. So what was the number? Let me go back. Let me do it in here and with Excel. If you want to write a function in Excel, if you want to write a formula in Excel, you have to start with an equal sign. And then from there, you will go to the row that we're in, which was 9328 plus. All right. And then I want to take 22% of the amount over. So I'm going to do 0.22. Now, in math class, you learn that if you do this, you have to be multiplying, but in Excel, it doesn't know that. So you have to use a multiply. And then you do the parentheses, which is shift 9. And then I want the amount over 81,050. And then end the parentheses. Because if you don't end the parentheses, then it doesn't know it's looking for more. So, all right. So 24,937 is the correct answer. I will fix that. Okay. So, and then for tax on a married couple with taxable income of 22,000, married couple 22,000 is just going to be in this second row. So you'll do 1990 plus 12% of the amount over 19,900. Okay. So what it's doing is it's taking 10% of your first row. And then when you move to the second row, you get the benefit of the lower row. So you just do 1990 on your first 19,900 and then 12% on the excess. And then this 9328 is your first amount taxed at 10%. And then this range taxed at 12%, and then the next range at 22. So it's always looking at the previous row, and you always get the benefit of the lower bracket. Okay, so down here, you're just going to answer yes or no. It's not going to tell you if you're right, but I want you to go find out, are lottery winnings taxable? And the answer is yes. And then workers' compensation, life insurance, bartering, and then are these deductible? A gym membership? Nope. I'd like it to be, but it's not. So alimony paid. Yep. So go through and you guys are going to answer yes or no. All right. And then on these, a tax deduction or a tax credit. So let's spend a few minutes and let's talk about the difference between a tax deduction and tax credits. So tax deductions are all of the things that we've been talking about. Things like alimony paid, student loan interest, charity, like charitable contributions, medical expenses, home mortgage interest, contributions to a traditional IRA. So all the things that we talked about, everything so far, those are all considered tax deductions. But tax credits, these are the good ones. These are the really, really good ones. Okay, so once you compute tax, then if you get any tax credits, you get to subtract that from your tax. Okay, so as an example, a tax credit would be the child tax credit. This is it 3,000 per child now? For some reason, it's not coming to me. Let's go look. child tax credit, it's the same for 2021 and 2022, but your homework is 21. 3,600 if your child is under 6, and between 6 and 16, it's increased from $2,000 to $3,000 per kid. So Nicole has a 3. Okay, so let's do a pretend. I'm stressing that this is pretend because I don't want you guys to think that this is the right numbers. Okay, so let's pretend that Nicole makes $50,000 and Tor makes $50,000. Usually I say that I make 100. Let's just pretend that Tor doesn't exist. That's terrible. Okay, Nicole makes $100,000. Now I don't. Let's just pretend, okay? Because it's a nice solid number. And so my gross income, let's say that I have no other income, okay? So 100,000. My deductions for AGI, I have none. And the reason why I have none is because I paid off my student loans. Yay! I paid off my student loans. I don't use a traditional IRA. I would do Roth, or I have my retirement plan, which I'll teach you guys about later. I don't have any other, I don't pay alimony, thank God. Okay, so all those things, I have none of those. And so my AGI is $100,000. Okay, from there, my standard deduction. Let's say that I am a married person. Okay, so I guess Tortoise doesn't work. I don't really know. Okay, so standard or itemized. Okay, so my itemized deductions, let's pretend they're about 22,000. And so the standard deductions are all right here on page 10. So if I am a married person, my standard deduction is 25,100. So 25,100, that's my standard deduction. Okay, so AGI minus the standard gives me taxable income of $774,900. So if my itemized deductions, so do we want standard or itemized? Standard is 25,100, itemized is 22,000. Pick the bigger one. Okay, so taxable income is 74,900. Let's calculate tax on that. So we would use the tax tables. So the tax tables are here, and I said my taxable income is 74,900. So I am in the second row, just barely, but I'm there. 1990 plus 12% of the amount in excess of 19,900. So tax would be 1990 plus 12% times the amount in excess of 19,900. Okay, so that C61 is going to put that number right there. Okay, and so this is my tax. Okay, everybody see my tax? Okay, now tax credits are subtracted from the 8590. Now, normally what you would do is you'd stop here. And so what I just calculated was what I should have paid in taxes. Okay, so my very basic explanation from earlier, I said that we have my 1-minute explanation. I said all through the year, you work, you have money withheld. At the end of the year, they send you the W-2 and it says what should have been withheld, or what was actually withheld. The W-2 says what actually was withheld. From there, you calculate what should have been withheld. That's this number. So then I would look at my W-2 and I would say if my withholding was 5,000, I should have paid that. So that means that I would have to write the government a check for $3,590. Okay, so I'm going to say that again. I calculated tax on what should have been, what I should have had withheld. I should have had withheld $8,590. If I only had 5,000 withheld, I owe the government money. If I had 15,000 withheld, then they would give me money back. Okay, that's how this works. Hopefully some lights just went on. I don't know. Okay, so let's pretend my withholding was $10,000. Okay, So without the kids or anything else, I would be getting some money back because I should have had 8590 withheld. I had 10,000 withheld, I'd get some money back. But my tax credits, 3,000 per kid. So $9,000, maybe $9,000. So I also had $10,000 withheld. So my refund then is going to be huge. I'm going to get $10,410 back. Okay. And that's because I didn't actually need to have any withheld because the tax credits wiped out all of my tax. Tax credits are the best thing ever. If this 9,000 would have just been a deduction, that 9,000 would have just been a deduction, then it would have changed my taxable income, which would change my tax, but not by much. So if this would have been a deduction, let's ignore these things for now. Okay. So if the child tax credit, instead of being a child tax credit, it was a child deduction, then I would do minus 9,000 here. And then I would have 91 for AGI and 65.9 for taxable income, giving me tax of 75.10 instead of 85.90. So it's helpful. It's helpful. But 75.10, 85.90. So the difference is around 10% or whatever, right? So it's saving me about $1,000. But when I can subtract 9,000, then I am at a refund immediately. I'm already getting $410 back, and I'm getting back all of my withholding. So that's a tax credit. Examples of tax credits: child tax credit, educational credit. So educational credit, 2,000 on your first 2,000 spent. I could talk about education credits a ton more than this. I kind of need more room than this. So right now I will just put up to 2,500 credit per person. Okay. So the way that it works is in your first 4 years, you take the American Opportunity Credit. So you guys, this is important because a lot of you are college students. All of you are college students. And so if you're a full-time college student, then in your first 4 years of education, undergraduate education, you could take the American Opportunity Credit. And the way that credit works is it's a $2,000 on your first 2,000 spent. Okay. If you get a loan, that's fine. Student loans count. That doesn't exclude those. And then it's 25% of your next 2,000 spent. Okay. So that's where 2,500 comes from. This is 2,000 and 25% of 2,000 is 500. So if your educational expenses are 3,000, then you would get 2,000, and then you would get 25% of the next 1,000, and you would get a credit of 2,250. So as long as your education expenses for the whole year are at least $4,000, you get a credit of 2,500. So if I had the 3 kids and I had one older one who was also a college student, I could subtract that another 2,500. So another 2,500 that would go back into my pocket. Okay, so tax credits are dollar for dollar back in your pocket. So as far as your homework goes, I just want to know if these are credits or just regular deductions. And so you can Google and find the answers to those things, find some reputable source. Tab 2. Okay, so it's 3 more of those where you just have to calculate tax. So we have a head of household. Head of household, we talked about, that's somebody who has a kid that that is not married. Okay, so all right, I wrote these problems for students, current students that I have. And so many of you may know Manny or Waylon or Kevin McKenzie or Cooper. There's Cooper Christian, and there's also another Cooper that I know. Can't think of his name right now. Dawson. Anyway, so Manny, single dude. All right, so he's single and he makes $40,000 from his wages as a chef. Okay, so what we're going to do is we're going to put the numbers in here and it's going to check your answer. So let's do it. Wages, he makes $40,000 in wages as a chef. Look, it's already trying to populate it. I didn't delete all the numbers, and so that's nice. He has an ex-wife that he pays child support of $4,000 a year and alimony of $2,000. Child support, not considered a deduction, okay? You do not get to write off child support. But alimony, yes. So I'm going to put it in as a negative because it's a deduction. He doesn't claim any dependents. That's important. So that means that the child support he pays, he doesn't get to claim those kids. The wife claims them. Each person is only claimed by one person. So he pays student loan interest of $150. So I'm going to subtract that $150. He had withheld $3,100 from his paycheck. Okay, so this number right here is just summing up these. And so I have $37,850. So if we take 40,000 and we subtract 2 and we subtract 150, we get 37,850. From there, you get standard or itemized. There will be no itemized deductions. All the people on this page will be taking the standard deduction. Okay, so to find Manny's standard deduction, I need the notes. Manny is a single guy. The year is 2021. Manny as a single guy gets $12,550. Okay, so minus $12,550 gives him taxable income of $25,300. And then we need tax from the tables. $25,300 single guy. The year is 2021. Manny is a single guy. His tax is between $99.50 and $45.25 because he's sitting at $25,300. Okay. So the tax is $995 plus 12% of the amount over $99.50. So equals $995 plus 12% times the amount over $99.50. The amount over. So that number, so you can type 25,300 minus 99.50. Now you can do all of it on a calculator and then just type in the number here, but it looks like his tax is 2837. So that is what he should have had withheld. We just computed what he should have had withheld. And so we will take what he should have had withheld and we'll subtract the 3,100 from his paycheck. And he should be getting a refund, right? If it's negative, it's a refund. He should be getting some money back. Correct. Can you have some ice cream? Yeah. You had sausage biscuit? Okay. Okay. So you're going to take care of Waylon. And so you're going to figure out these numbers. And then his AGI will carry over here. You'll do standard or itemized tax from the tables. And then this number, you're going to enter it as a negative number. And so how many kids does he have? 4. Oh, good grief. So that'll be minus 12,000. That's a lot. That's a lot of tax credit. Okay. So then actual tax. If we do one of these down here, maybe. Kevin, I wrote enter it as a negative here. I'm trying to decide which one I want to do. I can take care of Waylon, I guess, because so I'm trying to decide which one I want to do. Okay, I'll take care of Kevin. Kevin is a divorced, bitter man who works as a sous chef for Manny and Waylon. His wife left him, sorry, Kevin. But he kept the 2 kids that he lovingly named Cooper and Dawson. He makes $25,000. All right, that's good. He receives child support of $10,000. But we don't include that, right? Child support is not income. Oh, he went to the casino? Not everything was bad for Kevin as he won $5,000 at the casino. Good job. Okay, so his AGI looks like 30,000. Now you can just type 30,000 here, but because I'm an accountant, I will type sum equals sum parentheses and highlight those 3 and end the parentheses. Okay, so if you want, you can hit the auto sum button right here and it'll sum it up for you. His standard deduction. All right, Kevin, does he claim those kids? Bored, his wife left him, but he kept the 2 kids. Okay, so Kevin, I was trying to figure out if he was single or married or what, but his wife left, so he's no longer married. So he's not a surviving spouse. That's that qualified widower. But he's not married, so he can't be married joint or married separate. He's head of household. So head of household is 18,800. So his standard deduction is 18,800. So his taxable income is 30,000 minus 18,800. Now, I want you to notice on that cell that if you do minus, then you would minus a minus, and that makes a plus. So make sure this number is 11,200. And then let's compute tax from that. So tax from the tax tables. Head of household, 11,200. Head of household, 11,200. Ooh, he's in that first row. That's a good row. Yeah. Okay, 10%. So all you have to do is take 10% because you don't have any excess and the amount over, and you don't have any over. So 11,20. His tax credit, how many kids does he have? 2 minus 6,000. So that already gives him a refund of 4,880. And then he has some withheld, what, 2,100? So he's going to get back the 2,100 also. So he's actually going to get a check from the government for $6,980, which, considering that he only makes 25 grand, that's huge money, huge money. That's amazing. Okay. And that's because of this tax credit. And so I did make a note here. In real life, Kevin would also qualify for the earned income credit, and that would increase his refund even more. And so the earned income credit is because he has earned income, because he's working and he's very low income, since his income is supporting Cooper and Dawson as well, his children, then he gets an extra tax credit based on that. And so that would increase his refund even more. We have Samaj. He loves him some Jesus, so he gave some money to the church. That would be considered an itemized deduction, but he's going to put that right here as a church contribution. And so I said you can write up to $300 a year as a deduction for AGI, even if you can't itemize. And so I mentioned that earlier. So you're going to put negative 300 right here. So his IRA contribution will also be negative. And so I want you to try to do these on your own and see how they go. So I've done a good chunk of this for you. I hope you feel pretty good about it. I hope you guys feel good about taxes in general. It's such an important topic that all of us need to understand. And at this point, you probably have more questions, and that's where you're going to go to the discussion board and you're going to ask some questions. So let me help you in any way that I can. I'm always here for you guys. And so, all right, I'll talk to you later. Thank you. Have a good week.